Hello. I wanted to give you some value today. I have been taking some training this week. My family is away. They are in the Okanagan. My wife is hanging out with her sister and her mom, having a blast, doing some estate planning. So I'm learning a lot about that. I'm taking some training from my East Coast mentor. I've been talking to my accountability partner about market cycles. And I've been listening to audiobooks. I've been listening to Untethered Soul. It's been fantastic. So I've been absorbing a lot of information this week, and I wanted to share some with you. So I have kind of a two-part video. The first part is going to be about market cycles and what I mean by that and how we're using some tools to protect ourselves from those. And the second part is going to be about joint venture structures with real estate, how we do it, how we set it up, and how we protect all the parties. So the first part is going to be about this market cycle thing. So me and my accountability were talking about a video we watched by Jeff Gunther. It's a very good video, and he talks about market cycles and how they're quite long. They're like averaging in history 18-year cycles. So those dips can often be forgotten. Even if you've been in the business for 10 years, you might not have lived through one of these dips. And one of the main dangers of these market cycles is being over leveraged through a downturn. You know, they say three things can wipe somebody out: ladies, liquor, and leverage. So we're going to talk about leverage. You got to have some tools in place to make sure that you're not going to be over leveraged when the market does eventually, inevitably, have a downturn. Some of the three things we're doing is: one, we're buying low; two, we're using our team of experts; and three, we're setting up our financial structure properly. So we're buying low. My business is to find off-market and discounted properties. So we make sure we're buying stuff with 10, 20, 30% equity. We're buying with a good chunk of equity protection on the buy. Second is using our team of experts. You know, we have brokers and bookkeepers and builders and a lot of experienced people working through this thing to make sure that we can, keep the wheels on the cart and keep it steady. And third is the financial structure. You want to be set up with strong cash flow. You want to be set up with cash reserves in the account, and you want to have some leverage caps to make sure everyone's comfortable so that if there is a downturn, you have the tools to make sure you can ride it out. Now, the second part is about joint venture structures. Every deal has people, and they have a deal, and then they have money. We have the team, we have the off-market properties, and then we use people that want above average returns through real estate to partner with us to make sure everybody wins. And there's two kind of ways we do that. We can either provide a fixed return, there's a lump of money and we give a fixed interest return, or we can do 50-50 ownership. And we mostly do the 50-50 ownership, but let's talk about pros and cons of each. When you get those fixed returns, the pros are that you act as a mortgagor, you get your fixed return, you put your money in, the real estate investor makes their deal, makes their money, and they give you your return. That could be monthly over time, or that could be a balloon payment at the end. And another pro is that it's relatively short term. Sometimes investors use these for flips, or they use them for buy, repair, refinance, and you can get in and you can get out with a decent above average return, which is lovely. The cons are that you could be leaving money on the table. The investor is going to make a lot of forced equity when they dispose of the asset, and you're going to be getting your interest. You can be protected through bare trust agreements and promissory notes and a mortgage registered on title. But the real estate investor is going to be making the big equity plays, and you're going to be in and out of short term, and you're going to miss out on some of that long-term wealth. The other structure is the joint venture structure, where you're a 50-50 owner. Now, some of the cons of these are that it's going to be longer term. It's more of a wealth play than a quick cash play. And another challenge can be finding the right partner. You got to find somebody you know, like, and trust, and that aligns with your values. And that's not always easy. There are a lot of people out there, but there's not a lot of people that can totally align with what you want to do and your values. Some of the pros, though, are that you're going to have a long-term relationship, and at the end of the day, when all the dust settles, between the cash flow, between the equity, between potential refinances and the forced equity, you're just simply going to make more money. So leveraging an expert team, finding the right property, and setting up the structure properly in the beginning is going to help you get through those cycles and make more wealth and more health, and give you some more time to work on the funner things in life.